Welcome in, everybody. My name's Abe Abich, and I'm the host, your educator for this evening's American Retirement Institute class titled Retirement Today. And we'll get started here in just a minute. Want to let you guys know that if you have questions through the webinar, that you can go ahead and ask those questions through the digital chat there in the conference, and we have team members on standby that are able to answer those questions for you as the webinar goes along. And want to let you know that we're scheduling virtual meetings right now with everything going on with COVID-19. Our business is definitely open, and we're open for consultations, but we've gone totally virtual. And so wanted to let you know that you can schedule a lab session. And really, that's the second part of this class. Tonight's first part of the class is going through a whole bunch of different retirement planning topics. And it's always been our intent to host a second part of the class, which is a lab. And in that lab, you'll bring all this information with you, come in and have a complimentary lab session and test all this information out on your retirement. So we highly encourage you taking advantage of that lab session because that's part of the course. It's complimentary and there's no charge for it. In the digital chat, we're going to drop in a live link to help you schedule those virtual appointments via phone, computer, video conference, and it'll be a direct link right to our calendar to go ahead and see what times are available in our calendar to help you better schedule a time to meet with us. We're hosting a virtual class, obviously, because a lot of businesses are closed, and to protect our participants and attendees, we wanted to continue through with the course, presenting the information and sharing it, because it's a lot of good, timely information. But to protect our participants, obviously, from coming out physically in person. But we know how vital a time it is right now to be sharing all of this really important retirement planning information at a time of such uncertainty with the virus that's going around, and then the markets reacting so adversely to all this uncertainty. Again, there'll be a live link in the digital chat room for you to click on and go ahead and submit your questions there, and live links to be able to schedule the lab session, which would be the second part of this course. I'm a retail financial professional. We have a financial professional services team. I've been helping people to retire successfully for 18 years here all over the DC metro area. And our headquarters is in Ashburn, Virginia. I'm one of about 100 to 150 financial educators across the country who've been invited to share this course with the general public to help to better educate baby boomers predominantly on how to retire successfully, or as successfully as possible. So we're going to go ahead and get started. The name of the course is Retirement Today. As you can see there on the screen, times are changing, and the retirement world is changing, and today is not your grandparents' retirement anymore. As you can see here, over the last 3 or 4 weeks, in 2019, the S&P 500 was up 30%, and in just 3.5 weeks, we lost the same amount. So it took a year for one of the major market indexes to be up 30%, and it took just 3.5 weeks for us to lose the same amount of growth in that index. Just 3.5 weeks, the quickest downturn and recession, I believe, in stock market history. So a lot of people think they can time the markets and kind of get in when the market's really hot and high, and get out right before the dip. And I think a lot of people got caught off guard here, unfortunately, in early 2020. So, my day job is I'm a retail financial professional. We help specifically people that are 55 to 75, those people 5 to 10 years away or less before full retirement, to cross over the finish line successfully and then enter into retirement successfully. Our clients are all over the DC metro area. They've typically done a really good job of saving and accumulating, and they have all this stuff. We put all that stuff into an actionable plan. an actionable retirement income plan that they can now follow for the rest of their lives. So they have done a great job of accumulating and saving, and their accumulation typically isn't the problem. It's the problems are everything that can affect their wealth. The problems are everything that can affect those assets and those savings. Major market downturns, higher taxes, inflation, healthcare, sequence risk. That's the risk to a retiree that when they're in the income phase of retirement, that when the market's down at the same time, they're also pulling money out for themselves, and that would create a double or triple negative. A lot of this we're going to talk about in our webinar today. Before we get started, I wanted to tell you a story about a guy named the Great Blondin. I don't know if any one of you have heard of who the Great Blondin is. You can probably Google him as we talk. But the Great Blondin was one of the greatest tightrope walkers of all time. He came over from France in the mid-1800s and settled into the New York area. And he was a daredevil and greatest tightrope walker of all time. So what he decided to do to make a name for himself, he wanted to join a circus or something like that. And to make a name for himself, what he decided to do in the mid-1800s was to tightrope walk across the Niagara Falls on a rope. And he did it many times without passing away. The first time he walked across Niagara Falls, I think 150 feet high, across one rope and made it over successfully. The second time he did it, he had his buddy on his back. He had a guy on his back, and I guess he wanted to up the ante a little bit. And he said, you know what? I got to make this more fun and entertaining and exciting. So I'm going to put someone on my back and walk across Niagara Falls on a rope. And he did that successfully. All of a sudden, time went by, and he was getting a really big name for himself, and people were kind of following him and watching what he was doing. And more people started challenging him to do more things on this tightrope as he walked across the Niagara Falls without falling. Another time, he walked across the tightrope, across Niagara Falls, 150 feet high, took a rope with him, some type of rope ladder with him, climbed all the way down the rope ladder, took a dip into the water or a cup of water, drank it, climbed back up the rope, and walked over the tightrope again successfully across Niagara Falls. Well, one of his last times he did this, he tightroped across Niagara Falls again successfully. And there was a gentleman on the other side that said, hey, would you dare to push this wheelbarrow across the tightrope across Niagara Falls? And the Great Blondin said, yes, I'll push that wheelbarrow across Niagara Falls if you jump in the wheelbarrow with me. And the guy said, all right, I'll jump in the wheelbarrow with you. And he did. And the Great Blondin pushed a gentleman in the wheelbarrow across a tightrope rope across Niagara Falls, 150 feet high, without falling, made history, Guinness Book of World Records and all these things, and is the greatest tightrope walker of all time. So I share that story with you to share with you that there are going to be two types of people who watch this webinar and tune into this webinar with us tonight. The first type of person is going to tune into the class, listen to the class, a lot of great content, and then take no action. You're going to listen to all the information, and you're going to say, you know what? I'm not crossing that tightrope rope with Abe or crossing Niagara Falls. I'm just going to come in and get all the information and go ahead and do things on my own and take all the information and do nothing with it. And that's okay. Some people will do that and some won't. The second type of person you might be is that type of person that's going to say, you know what, Abe, I need some hand holding. I'm going to jump in the wheelbarrow with you and cross over Niagara Falls successfully. So the people that end up working with us are obviously those people that jump in the wheelbarrow with us and trust us to help them cross the finish line into retirement successfully. And that's what I would encourage you to do tonight, is to jump in the wheelbarrow with us and not just absorb all this information, but put into action for your own retirement. All right. Why we're here, to get a candid, unbiased view of modern retirement. And one quick thing here I'm going to share with everybody. is just a little bit about myself. Well, if I can find that slide. Bear with me here as I get back to the PowerPoint.
This is our first time doing an online event, guys, so thank you so much for bearing with us. Abe, let us know if you need any help.
Can you see the screen now?
Just your face.
Interesting. All right. Oh, here it is, right here.
Beautiful.
Okay, so let's pause it again. Let's see here.
It might just be that one slide.
Here we go. Yep. Okay. Can you see the slide okay there? Angela?
We can see retirement today, but we can't see your face anymore. I think you turned off your face camera.
Okay.
There we go.
All righty. All right. So why we're here, to get a candid, unbiased view of modern retirement planning. It's not your grandfather's or grandmother's retirement planning. A lot has changed. And so if you have your textbook that you received, the book that we would have sent you in the mail, you can flip to, let's see here. Basically, it's a table of contents, and that goes through all the chapters there, gives you all the information that's in the chapters. But if you flip to page 2, then that'll give you an introduction of a lot of the content. So a lot of things are changing. Obviously, with this COVID-19 virus, I don't think anybody expected something like that to happen all of a sudden and to really knock the markets totally off. And so there's a lot of things that we have to prepare for. What we'll be covering tonight, we'll be talking about taxes, Social Security, different insurances, estate planning, income and retirement, and financial tools that you can use in retirement to help yourself. And this is from John Bogle, the former founder and former CEO of Vanguard. If I've learned anything in my 52 years in this marvelous life, it's that for a given individual or institution, the emotions of an investor have destroyed far more potential investment returns than the economics of investing have ever dreamed of destroying. What that means is that by having proper planning done in place and in advance, we don't have to react with emotions. Instead, we can react with proper planning and say, you know what, the market's going to go up and down the rest of our lives. I have monies in different places for different reasons. I don't have to panic. I don't have to worry about this. And I've done the planning in advance because I know that the market's going to go up and down the rest of my life. And that's healthy and normal for the market to do so. But it's so important to have planning done in advance. That way you don't have to worry as much and you can sleep better at night and have better sleep insurance. Introduction, this is on page 2 of your workbooks. Fresh challenges have changed the retirement landscape. Interest rate changes. As we all know, in the last couple of weeks with the market pretty much tanking, the Federal Reserve is just coming out with everything in their willpower to save the economy, and that includes reducing interest rates to all-time, never been hit before lows. Mortgage rates are dropping. The 10-year Treasury yield has fallen to an all-time historic low. And that puts pressure on everybody because if you can't earn very much on safe money instruments like CDs and money markets and cash and treasuries, and stocks are super volatile, where you can earn 30% in 1 year and lose 30% in 3 weeks, then where do you go? Record-breaking market conditions and volatility, that's the obvious right now. Global debt, geopolitical shifts, tax changes. Our tax brackets and rates have dropped over the last 2 years, and we're going to talk about that tonight and how you might be able to take advantage of that. A shift in employee retirement plans, a Secure Act was passed in December of 2019, and we'll talk about that tonight too. 2008 market crash, and you know what? We're pretty much in the middle of one right now, perhaps one of the worst ones since 2008, and we'll see if it gets better quickly here or worse than 2008. Introduction, milestones to retirement. This would be on page 3 of your textbook. So some key ages here to make sure you're aware of. At age 50, contribution limits change to your retirement plans. So in a 401k, we can take advantage of what's called a catch-up provision. And for anyone under 50, there's not a catch-up provision. Once you get 50 and older, you might be 10, 15, 20 years away from retirement, and the government allows us to contribute a catch-up provision and to contribute more into the plan than we were able to before age 50. At age 55, some retirement plans you may have access to. Most plans, however, 401ks, TSPs, allow us to access money without penalty come 59 and a half, at age 59 and a half. At age 60, if you're a widow, you can actually receive widow and survivor Social Security benefits. If you're not a widow, then the earliest age you can start drawing down on Social Security would be age 62. And we'll talk about that here in a few minutes as well. And as you can see right there at age 62, that's the first age most people are eligible to start taking Social Security benefits. A few more ages there. At age 65, obviously Medicare kicks in. At age 67, that is full retirement age for anybody born in 1960 or after. Age 70 is the latest year in which you can take Social Security. And if you waited till 70, you're part of 3% of the population. Only 3% of Americans wait until age 70 to start taking Social Security, and that should tell you something. At age 70 and a half, well, in December of 19, Congress passed what's called the Secure Act, and if you weren't already taking RMDs in 2019, then RMDs have now been pushed to 72. Okay, so that's brand new, just 3 months old. If you were already taking RMDs, you're grandfathered in. You can't bump them to 72 and after. You have to continue to take up your RMDs. But if you weren't 70 and a half yet in 2019, then you can now push RMDs to age 72. So that buys you another 18 months or so to be able to defer those qualified monies, defer those required minimum distributions, which can be helpful in a down market like we're in right now. Section 1, taxes. This would be page 6 and page 7 of your workbook. So flip to that, those pages in your workbook and follow along with me here. Federal income taxes. One of the biggest myths of retirement planning that I've heard over my 18 years of helping people to retire successfully is that we should max out our 401ks, our TSPs, our IRAs, because in retirement, we're going to be in a lower tax bracket. And I can't tell you how many people that is false for. Okay, we have a lot of clients that have worked for the government with big pensions, 50,000, 100,000 a year. Then Social Security comes in on top of that. Then annuity income and dividend income and rental income. And a lot of our clients here in the area have higher incomes in retirement than they do when they're working. So to assume that you're going to be in a lower tax bracket in retirement is not a good assumption, not a safe assumption. Taxes that are at really all-time historic lows right now, and it's something we need to take a look at when it comes to Roth conversions, purposely paying tax now on some of our qualified dollars. We need to take a serious look at that. Another reason why you may not be in a lower tax bracket when you retire is because a lot of the deductions you had when you were working are gone now. Your primary house is paid off. Okay, a lot of our clients have their primary home paid off. Your kids are out of the home, hopefully. And you stop contributing to your TSP, 401k, and IRAs because you're not working. So you're not contributing to those accounts anymore. You don't have all that extra income to be able to do so. Those are 3 major deductions that you had when you were working that you don't when you're retired. And for that reason alone, you could be in a higher tax bracket. or be in a similar tax bracket and have more taxes. So a lot of people think they'll be in a lower tax bracket when they retire. A lot of people think they can just follow the 4% rule when it comes to retirement planning and retirement withdrawals and distribution. And that doesn't work every year. You know, if this year in 2020 ends up being a down year for the market, which it could easily be, then following the 4% rule every year doesn't work. So we don't believe the 4% rule rings true anymore. Matter of fact, the financial advisor that developed the 4% rule, which means we should only take out 4% of our retirement monies every year so that we don't run out of money, came back out here in the last few years and said, now, with people living longer and with interest rates being lower than ever, we should only take out 2.8 to 2.9% of our retirement dollars in retirement so that we don't run out of those monies. Because some years are going to be good and some years are not going to be. Here is the biggest difference in the federal tax brackets. Yes, these are the new brackets. These are the lowered brackets from 2018. So in 2018, Trump and Congress lowered federal tax brackets. They were already reasonable, and now they're lower. Taxes are on sale. So we'll say this a lot on our radio show. Taxes are a good deal right now. To be paying 12, 22, 24%, as you can see on the screen right here, in federal tax is a really good deal. That means you're keeping 80, 90, 70% of all the money you have in income in your pocket. And only 10, 20, 30% is going out to taxes. That's a good deal. Taxes could easily be higher down the road. And so if they go up on us, that's one thing that we can't control. You're going to be paying more taxes to Uncle Sam when that happens. So one thing we can do is we can take a look at where we're at in these brackets, okay? But let's say you're a married couple and you're in this 24% bracket and you're bringing in, let's say, $200,000 of household income, which is very average or a very common thing we see here in the Northern Virginia area. Bringing in $200,000 as a married couple, you would be smack right in the middle of that 24% bracket that you see there on your screen. What the IRS is telling you is that you can make up to and bring into the home another $121,000 of income and still just pay 24% of federal tax. You can make another $121,450 of income and still stay in the 24% bracket. That's a pretty good deal, okay? In other words, you're keeping 70, 75% of every dollar that you make and bring in retirement. That's a good deal, and that's something we need to take a look at. Because if taxes go up to 30, 35, 40, 50%, you're going to be paying much more to Uncle Sam down the road than you would today. So one of the things among many that we help our clients with are Roth conversions. And we're not accountants in our retail practice. We're not accountants or tax professionals. But what we do help our retiree clients with is tax planning when it comes to their investments. And so we have tax planning software called Tax Clarity, where we'll put all of your income together into the software. We'll find out where you are in those brackets, and we'll find out how much room, if any, we have in the bracket to do a Roth conversion. Now, if you believe taxes are going to be lower than they are today, 5, 10, 15, 20 years from now, you're never going to do a conversion. You're just hoping that taxes are going to be lower. Hope is not a good, solid retirement strategy. So let's control what we can control. All right. So after this new tax code came out, they did a poll, and they polled thousands of Americans to try to get a good feeling for how they understood the new tax system and tax code. And what they found out was the people that did this poll found out that 50% of people believe one thing about taxes and 50% of people believed another thing about taxes. So let me give you an example. How important is just $1 in extra income? How important is that as far as it pertains to taxes? Is that going to really affect your taxes a lot? Well, the largest tax bracket jump in the tax code is from 12% to 22%. So what happens if your income goes from $78,951 to $78,952 and you move into the next tax bracket by just $1? Well, people that were running this poll asked people about this, and a lot of people responded and said, well, I'll be in the next tax bracket. All my income will be in the next tax bracket. The other half of people said, no, That's not what's going to happen. Taxes are progressive. Only that next dollar is going to be taxed in that next tax bracket, and that's the correct answer. But 50% of people, of Americans polled, thought one thing, 50% of Americans thought another. And that goes to tell you how complicated our tax system is. Even after Congress tried to simplify the tax code, it's still pretty complex and difficult to understand. So only that next dollar is taxed at the next bracket. This gives you a good example of what's called a personal tax map, a personal tax mapping report. And so this can be done through the tax planning software that we have available and make available to our clients. Again, it's not going to do your personal tax returns, but we can throw all of your income into the software, find out exactly where you are in the brackets that you're in to determine if it makes sense to do anything like a strategic Roth conversion. The new federal tax code. Let's talk about some big changes. And so this can be found on, again, page 9 in your workbook. And so one of the big things that changed here is standard deductions, okay? And so standard deductions increased in a big way. And the standard deduction for 2019 for a married couple is $24,400. In 2020, I think it increased by $200 or has increased by $200 to $24,600. And then for a single person in 2019, the standard deduction is $12,200, and that is increased by $200 as well, I believe. If you're 65 and older, you get an additional $1,300 in deductions per person. So if you're married, that's another $2,600 in deductions on top of the $24,600 that you had in standard deductions, or that any married couple would get. And if you're single and 65 or older, it's an extra $1,600 in deductions on top of the $12,200. So that's a total of about $14,000 in standard deductions for someone single, 65 or older, and a total of almost $27,000 in standard deductions if you're 65 or older and married. And the goal was to not only simplify the tax code, which I don't think happened, but the goal is also to reduce the number of people itemizing deductions and to use the standard deductions for the most part. And I think that's exactly what has happened. Federal income tax deductions in retirement. Here are some of the common tax deductions that may no longer be available. Well, interest on mortgage deductions is still available up to a cap of $750,000 or up to a cap on a $750,000 mortgage loan, which many baby boomers don't have that type of mortgage. A lot of baby boomers have their house paid off or substantially paid down. Tax deductions on 401ks, we still have those, but these things could change. These things are still around, but they could change if the tax code changes. Now, the current tax code is scheduled to revert back to the former tax code in 2017 and beyond. That will happen in 2025. So we have 5 years in the current tax system, unless something changes this fall, where we can take advantage of current rates and brackets. Here's a tax chart. This is also in your textbook if you want to follow along, page 11. Federal tax rate through history. Take a look at how high federal income tax rates were in the 40s, 50s, and 60s. In the 40s, 50s, and 60s, federal income tax rates were over 90%. Over 90%. Ronald Reagan was an actor in the 40s. He only worked 6 months out of the year because in the 40s, if you earned over $200,000 a year, federal income tax rates were over 90%. So he only worked 6 months out of the year because he earned $200,000 by that point. And if he would have worked a 7th month or an eighth month, 90 cents of every dollar he would have made from that point on would have been taxed at 90%. Now, we had world wars, we had different things going on back then, but we didn't have $23 trillion of national debt, which we have now. $23 trillion of national debt. And we've been preaching over the last 10 plus years or so that federal income tax rates have to go up in the future. One of the reasons why they have to go up is because of our blooming $1 trillion of debt, a blooming $23 trillion of national debt. Ironically, Reagan becomes president in the 80s, and then from the early 80s until 2020, taxes, as you can see there, have pretty much flattened out between 20 and 40. And then 2018, Congress lowered tax brackets and rates, and they're now at, for the most part, 12, 22, and 24%, which are very fair rates and brackets. Interest rates on public debt there. As you can see, the Federal Reserve, as you guys have probably heard of, the Federal Reserve lowered rates here twice and pulled out pretty much everything in their power to keep the economy intact. And so rates on the 10-year Treasury yield, rates on CDs, mortgage rates, money markets, those are all going down. And it's going to be harder and harder to get a decent yield on really, really safe money. Matter of fact, the 10-year Treasury yield here on in March of 2020 is less than 1%. It hit a low just a few weeks ago of 30 basis points, 0.30% or 0.40%, when in 2018, it was over 3%. New federal tax code. Our tax system, as I've already mentioned, is progressive, and you can see there in our personal tax mapping reports what additional income will do to your taxes. Tax deferred accounts in your retirement. See what page we're on here. We're on page 13 of the textbook if you're following along in the workbook. Taxes in retirement. Many pre-retirees and retirees have some type of tax deferred account. That's 401ks, TSPs, 403bs, 457 plans if you're a state employee. Then we've got SEP IRAs if you're self-employed, simple IRAs, traditional IRAs, and those are a lot of those pre-taxed accounts. Those accounts are taxed at whatever federal income tax rate you're at in retirement when you take money out. All right? You haven't paid a penny of tax yet on all that money you've plowed into those accounts. So naturally, when you retire, all that money will be 100% taxed at your ordinary income tax bracket, which right now for most people is 22 and 24%. Now, again, if taxes go up when you retire and those tax rates and brackets go up to 30, 35, 40%, you're going to be losing more money to Uncle Sam at that point. Two different types of taxes you can incur in retirement: ordinary income tax and Social Security tax. Believe it or not, although you've already paid taxes on Social Security benefits as you're working, every 2 weeks, what's coming out of your paychecks are taxes going to Social Security, FICA, Medicare. And guess what? If your income is just over certain thresholds in retirement, your Social Security income will be taxed again in retirement. Double taxation. It's not fair, but it is what it is. Key takeaways from the chapter here on taxes. Page 14 of your workbook. The tax deductions that applied during your working years may no longer be available in retirement. What are those deductions? Mortgage interest. Well, if your house is paid off, you can't deduct any interest. Of course, you've got property taxes, but the interest would be gone if the house was paid off. Your kids are out of the home, hopefully, so you've lost that deduction. You're not working anymore, so you can't max out your 401k, TSP, and employer-sponsored plans. And then federal income tax rates right now are historically low. That's number 3, could increase in the future. Number 2, Tax Cuts and Jobs Act of 2017 made some significant changes to the tax code that could affect your taxes in retirement. We need to be looking at things like Roth conversions if you believe that federal income taxes will be higher in retirement than they are today. Lower interest rates could mean higher taxes in the future. And number 5, your tax deferred accounts are taxed as regular income when distributed in retirement. Okay? All right, so that will complete chapter 1 on taxes. And on page 14, there's the key takeaways there in your workbook and lab book. At this point, what we'd like to offer in our lab session, as you come in for that complimentary lab session, is we'd like to offer you our tax planning guide and tax planning cheat sheet, so you can see all the different brackets, what are the different income ranges in those brackets, how much you can contribute to Roth IRAs, 401ks, what the catch-up provision is, how to calculate RMDs and all those different types of things. Those are included in our tax cheat sheet and benefit guide, and also in our personalized tax mapping report. If you're working with a financial professional out there and they're not talking to you about how to minimize and reduce taxes on your 401ks and retirement dollars, then give us the opportunity to allow you to put all your information into the software to see how we can help you reduce taxes, your taxes on your retirement dollars in retirement. You can't ignore taxes in retirement. They're our biggest expense. And so we need to do some strategic planning when it comes to taxes and retirement. Section 2, Social Security in the workbook. This is page 17 of the textbook. All right, here's a brief history of Social Security. In 1935, FDR signed Social Security into law. Okay, 1935, the first person started receiving a check. I can't remember her name. Let's see if it says it here in the workbook. I can't remember her name offhand, but there was a lady who received the first check. Okay, now when Social Security was first started, there were, I think, 150, 200, 250 people in the workforce for every one person receiving a check. Several hundred people out in the workforce for every one person receiving a check. Those are really, really good odds. Now, there are only 3 people in the workforce for every one person receiving a check. That's a problem. And if you've read your Social Security statements here recently, what you'll see on those statements is that there's a Social Security problem. And by 2034, if nothing changes with Social Security, then we may only be able to receive, or whoever is receiving Social Security at that time may only receive about 78 cents to 80 cents for every dollar of scheduled benefit. In other words, if you're scheduled to receive about $1,000 a month in Social Security, if nothing changes with the Social Security program, you're only going to receive $780 a month to maybe $800. Would you be able to survive if your benefits were cut by 20%? And so that's something we need to prepare for. I can tell you for myself, I'm 25, 30 years away before, 22 years away before even being eligible for Social Security. And if it's there, it's there. So I just wouldn't bank too much on it. And if it's there for myself, I'll take it. But I'm doing what I need to do to be prepared on my own. So timeline here of Social Security, going back to when it first started, all Social Security benefits were tax-free. Everybody receiving Social Security when the program first was implemented received tax-free benefits. 1983 rolls around and the government says, wait a minute, this is too good of a deal. We need to be able to tax those benefits by up to 50%. In other words, 50% of the Social Security check could be taxed at your ordinary income tax bracket. So let's say you're at a 15 or 20% tax bracket, 50% of your benefit would be taxed at that tax bracket, and that's exactly what happened. 1993 rolls around, and the Congress says, hey, wait a minute, we need to tax these benefits even more. So they rolled out an amendment in the early 80s that said up to 85% of your Social Security check can be and will be taxed at your ordinary income tax bracket if you're over certain income thresholds. So if you're married, and I think we'll go over these thresholds on the next slide, if you're married and you're receiving only $44,000 of income in retirement, then your Social Security benefits can be taxed up to 85%, or 85% of your Social Security check can be taxed at ordinary income tax rates. If you're single and your total income is $34,000 or more, just $34,000 or more, then 85% of your check can be taxed at your ordinary income tax bracket. All right. And here are those thresholds I was just talking about. So as you can see there, if you're single and you're bringing in less than $25,000 a year of income, then your Social Security income is tax-free, which it should be. If you're married in retirement and your total income in retirement is $32,000 or less, then your Social Security income is tax-free. If you're married and your total income in retirement is $44,000 or more, as I mentioned there, 85% of your Social Security income check will be taxed. And if you're single and your total income is just $34,000 or more, then 85% of your Social Security income check will be taxed at your ordinary income tax bracket. This is the formula that Congress uses to determine those threshold numbers. Your modified adjusted gross income plus half of your household Social Security benefits plus any tax exempt interest. Those 3 things combined come up with that formula there, or you add those three numbers together to come to this formula. And if you're single and it's more than 34, married or more than 44,000, 85% of your Social Security income check will be taxed. Let's see here. So here's an example. Joe and Ann, they've got $80,000 of total household income. $30,000 in pension income, $30,000 in RMD income, half of their Social Security income, half of their household Social Security income is $20,000. Those three things total 80. That 80,000 is more than 44, so 85% of their Social Security income will be taxed at their ordinary income tax bracket. Let's take a look. As we can see there, 80 is more than 44, 85% of their Social Security is taxed, and here's how it works. Here's the formula. So 40,000 times 85% is 34,000. 34,000 at their ordinary income tax bracket of 22% is 7,480. 40,000 minus 7,480, that's their total Social Security benefit, is 32,520. And so that's the taxation on Social Security. And there's the threshold right there. Over 78,950, but not over 168,400. And that's how we come up with that math. Outlook on Social Security. So let's see where we are in the textbook here. We're on page 21. If you're following on in the textbook. So in 2017, we kind of talked about this already. There are reductions coming to the program. Now, what do I think is going to happen with Social Security? I think a couple things could happen. Number one, full retirement age could get pushed back. Right now, full retirement age for the youngest people in America, anybody born in 1960 or after, full retirement age is 67. I think that could get pushed back to age 70, 72, 75. Number one, there's no more Social Security money. All Social Security benefits are being paid out by current tax revenue that's coming in from citizens. So there's no more trust fund. There used to be a Social Security bucket of money, a trust fund, but that was kind of taken from to pay for other programs, Medicare and other programs. So there's no more trust fund. And we need to be prepared that in 2034, we could have a reduction in benefits, as you can see, by as much as 25%. So I hope that anybody currently receiving Social Security will not be affected, or anybody about to receive Social Security will not be affected, but instead they will change the younger generation Social Security benefits first. As you know, myself, I'm 40, I'm 25, 30 years away anyways before I would need it or want it. That's a lot of time there for me to prepare. Not so much time if you're 62 and considering receiving Social Security in the next 2 or 3 years. Now, Social Security has generally come with a cost of living adjustment. This is on page 23 and 24 of your workbook. And as you can see there, the government gave us some pretty liberal cost of living adjustments. Take a look at how high the cost of living adjustments were in the 70s, 8, 9, 14%. Now, I know interest rates were much higher then, but then they gradually have come down, as you can see here. And in January of 2020, the cost of living adjustment was 1.6%. So what we found here in our office is that we looked back at cost of living adjustments over the last 20 years, and we found out that the average cost of living adjustment was about 2%. So when we're putting together our retirement income plans for our class attendees, for our clients, we usually use a 2% cost of living adjustment when it comes to Social Security. But we need to make sure that our Social Security and that our retirement income in general is keeping up with inflation. The 30-year inflation average is 2.5%. All right. If you haven't set up your Social Security statement or an account online, I would highly encourage you to do so. You see some links right there on the screen, ssa.gov. That's the Social Security Administration's website. I've done it for myself, and it's pretty neat because you can see every single year. I can go back to when I was 16, working at McDonald's. That was my first job, and I could see what I earned there when I was 16 and what I've earned over the last 24 years. And that's really important because guess what? The people working at the Social Security Administration office are humans, and they make mistakes too. And I can't tell you how many times our clients have come in, they've shown us their statements, or they've looked at their statements, and they said, wait a minute, I didn't get my income counted for 2017. The Social Security Administration missed my income for 2010. And so mistakes can be made, and it's important that we're looking at those statements to, number one, not only see what our monthly benefits are going to be, at 62, full retirement age, and 70, but to make sure our earnings history is accurate, okay? Because we want to get what we worked hard for. When should you claim Social Security benefits? Man, if I knew this question for everybody that asked it, I'd probably be a billionaire or trillionaire. But man, this is a loaded question, and it's something that we really want to take seriously. We help our attendees that come to this class with this, and we help all of our clients with this when it comes to Social Security planning and when to best take Social Security. Give me 1 second to make sure these lights come back on here. All righty. So when do you take Social Security? Well, that's a loaded question, and it really depends on a lot of factors in your life. Number one, what it depends on is, do you need it? Are you still working? If you're still working and you don't need it, then you don't need it. Maybe you defer Social Security for a few more years and get that 8% compounded guaranteed return from the government. You can't get an 8% guaranteed compounded return anywhere. So maybe that's something you should take advantage of. Your health. You got to look at your health. We have some clients sometimes that have some health conditions, Parkinson's and strokes and things like that. And if you've got some health conditions, cancer, then your life expectancy may not be as long as someone without that same condition. So that's something you want to take into consideration. And you probably don't want to defer your benefits till 70 if you've got heart disease and you had a heart attack in your 50s and 60s. Might not be worth it to wait that long. You might not reap the benefit by waiting until 70. Now, with that being said, every year that you defer and delay Social Security, as I already mentioned, that benefit grows by 8% compounded every single year. 62 is the first year that most people are eligible to take Social Security benefits. And you can see here in the PowerPoint presentation here that based on the year you were born, my father was born in if I can remember now, 42. And so his full retirement age was 65 and 10 months. My mom was born in 1945. She falls right in the middle of that age group right there, and her full retirement age was 66. Anybody born in 1960 and after, their full retirement age is 67 years old. Benefits grow by 8% every year we defer and delay them. Interest rates are also something we want to consider. Hey, interest rates are really, really low right now. So we can't take this money, go to the bank, and get more interest on our money than the 8% guaranteed roll-up that Social Security is giving us. But if this were the 80s and we could walk down to Bank of America and get 15% on our banking accounts there at the bank, then maybe we take the benefit, we pocket it, and we invest it safely. A lot of things to consider. The break-even point. So we can do the calculation for you. We can put your specific birth dates into our Social Security planning software to help you determine when it is best to take Social Security. We had one gentleman that came to a class of ours years ago on how to maximize Social Security benefits. And he said to me at the end of the presentation, Abe, I always thought that waiting till 70 was the best age for anybody to take Social Security because the benefit's the largest. Well, what if you die at age 71? What if you pass away at age 80? It would not have been worth it to wait till 70. You would have been better off taking benefits in your early to mid 60s. Matter of fact, the sweet spot for taking Social Security benefits is in between 65 and 69, and only 3% of Americans wait till age 70 to take those benefits, and that should tell you something. Break-even points and putting that into our personal tax mapping reports here. So we can give you those real raw numbers instead of just, kind of thinking about when is best for you to take Social Security and making that decision on a whim. We can run those numbers, put in your birth date specifically into the reporting software and give you the exact numbers. Hey, here's what your benefits would be over your lifetime if you took benefits at 62. Here's what your benefits would be over your lifetime if you took them at 66, 68, 70, and then let you choose based on your life circumstances as to when is best to take those benefits. Spousal benefits. We had a couple come into our office a couple years ago, and they weren't aware that the wife was eligible for a spousal benefit. Here was this couple's situation. The husband was the breadwinner. Okay, and his Social Security benefit at 65 was $2,500 a month. The wife's benefit, because she was a homemaker and didn't earn as much money over her career, was, let's see here if I can remember it right, was around $700 a month, maybe 800, I think about $700 a month. So her benefit, and they're both 66, by the way, when they filed for benefits, her benefit was less than half of his. What they didn't know, and they were working with a big time financial planning institution that everybody's heard of here. What they didn't know, and what their advisor didn't tell them, is that they're eligible for a spousal benefit, or she is eligible for a spousal benefit to equal 50% of her husband's. So her husband's was around 2,600, hers was around 700. Okay, and what half of his would have been 1,300. What they didn't know is they were eligible for a $600 monthly spousal benefit to sit on top of her benefit that would equal 50% of the husband's. Their financial advisor they were working with didn't know that, didn't let them know. They come into us for a lab session, a second opinion on the retirement plan. We were able to basically let them know, hey, did you know you're eligible for the spousal benefit? $600 a month, $7,200 a year. If they live another 20 years, or if she lives another 20 years, that's $150,000+ that's now in their pockets from coming in and getting a second opinion from another financial professional. How do I qualify for benefits on my ex-spouse? Well, you got to be at least 62. You have to have been married for at least 10 years. You aren't entitled to a higher benefit on your own, and you have not remarried. Your ex-spouse is eligible to receive benefits as well. That means they would need to be 62 for you to claim an ex-spousal Social Security benefit on your ex-spouse. Your ex-spouse's benefits will not be affected. Okay, this is just a benefit you're entitled to for being married 10 years or more and having been divorced. Working after claiming benefits. So this is page, let's see here. This is page 31 of your textbook, if you're following along. So working after claiming benefits, if you claim benefits between age 62, which is early retirement, and full retirement age, so let's just say between 62 and 66, and let's say that benefit is $1,000 a month, and your working income, as you can see there, is more than $17,640 a year, then the government will hold 50% of that Social Security check, $500 a month. They will hold $1 for every $2 over the limit. So 50% of your Social Security check will be held and then given back to you in a lump sum when you hit full retirement age. It's not a penalty. It's not a deduction that you lose out on. It's a benefit that's withheld because you're over the limit there, the working income limit, not income from dividends, rental income, annuity income. This is just working income. So if you take Social Security benefits early, between 62 and 66, and your working income is over about $18,000 a year, half of your Social Security benefit will be withheld and given back to you once you hit full retirement age. Keep that in mind if you're taking Social Security benefits early. Social Security takeaways. This is on page 32 of the workbook. Social Security was created to help retirees and aging adults receive income after working. It was only designed to replace 40% of that working income. And now for most people, it's probably far less. Number two, Social Security benefits can be taxed up to 85%, not at an 85% tax rate, but at your ordinary income tax rate. But what that means is 85% of your check can and will be taxed if you're over those certain income thresholds that we talked about. Inflation created the need for cost of living adjustments. So we saw that happen over the years. And now the average Social Security adjustment, cost of living adjustment is about 2%. Taking benefits before full retirement age can reduce your benefits. We just talked about that. If you're over $18,000 a year of part-time working income, 50% of your check will be withheld and given back to you once you hit full retirement age. Number five, spouses can claim up to 50% of that spouse's benefit. And that goes to that story I just shared with you a minute or two ago, where the couple didn't know that they were eligible, or she was eligible, for a spousal benefit to equal 50% of the husband's benefit. Number six, retirees can work and still receive reduced Social Security benefits. Another thing to point out is that when you hit full retirement age, let's say that's 66 for you, 67 for you, you can make and earn all the money in the world and not have your Social Security benefits reduced. All right, we're just going to take a minute or two break here, and then we're going to come back and we're going to start on the healthcare, long-term care, and life insurance section. That starts with on page 35 of your workbook. And we're just going to take a 2 or 3 minute break here, maybe 5 minutes, come back, get a sip of water here, and then we'll start on section 3, page 35 of your workbook. So I will be back here in just a couple of minutes. Also, just a reminder, if you have any questions, go ahead and enter them into the digital chat there. We've got team members on standby, so go ahead and enter your questions in, and our team members will let me know what those questions are. We'll get them answered for you. In addition, there should be a live link in the digital chat room for you to schedule a complimentary lab session with us. This is the second part of this course. It's complimentary. There's no charge for it. And really, it would be a great idea for you to take all this information and see how it affects you. Apply it to yourself, put it together into an actionable plan that we would put together for you, so you can see how all these things are going to affect your lives and your retirement. I'll be back in just a few minutes.
Beyond the ICU, Emily and Billy.
All right, everybody, we're going to go ahead and get started again. So we're on section 3, page 35 of your workbook, 34, 35, and forward. And in this section, we're going to talk about insurance and how that plays a part in your retirement. So one of the things that our class attendees and our clients like about us and how we help our clients prepare for retirement is that not only is growing and accumulating assets for your retirement very important, but protecting and preserving those assets and protecting what you've worked so hard to build is extremely important to the people that attend our classes and our clients. So we're going to talk about insurance and some of these different insurance policies you're going to need. Some of them you won't need. And we'll talk about which ones are important to have and how some of these insurance policies and plans will affect your retirement. Healthcare, long-term care, and life insurance. So we're on page, again, 35 of your workbook. So one of the big things we talk about when it comes to what can affect your retirement is healthcare. Healthcare is one of the big 4 or 5 things that can affect your retirement and really drain your assets if you're not prepared for it. So major market downturns, higher taxes, which we've already talked about, inflation, we've talked about a little bit, higher taxes, certainly. I already mentioned taxes. Healthcare, which we're talking about right now, the average couple is going to spend $250,000 to $300,000 over their lives in prescriptions, extra surgeries, and just all kinds of healthcare needs that you haven't thought about that aren't covered by Medicare and your major insurance plans. So we need to have money set aside. We need to have plans in force to help us to protect our assets in case the unexpected health event happens. All right. So let's talk about some of the things here. 7 in 10 Americans age 65, 7 in 10 Americans are age 65 or older. People are living a lot longer, as everyone knows. You know, it used to be the norm for someone to live into their early 70s, mid 70s. Now the average male is living to about 83, 84. The average female is living to about 85, 86. 1 in 2 people in their 60s, if you're married and you're in your 60s in pretty good health, one of you will live into your 90s. One of my grandmas lived to be almost 95. One of my wife, Shelley's grandfathers lived to be 96. We were just talking to some people here recently, and the lady has 4 generations still alive. Her mother, her grandmother, and I believe her great grandmother. 4 generations. The point is that that oldest lady in the family is 100 or 103 years old. So people are living a lot longer. We need a plan for that. Medicare Part A covers the major things that you would want to have covered. This is the base part of the Medicare plan. It's going to cover inpatient hospital care. I don't have to repeat what you see on the screen there, but skilled nursing home care, hospice care, lab test, surgery, home health care. The major part of Medicare is going to be Part A. What is not covered in Part A is what you're going to cover for yourself in Part B and Part D. So Part B will pick up anything that's not covered in Part A, and Part D is for prescriptions. Those are the 2 supplements that you probably want to purchase when you hit 65 and older and you're first eligible for Medicare. If you don't purchase those supplements, then you might not have full protection when it comes to having your prescriptions covered and having all these other things that are not covered in Part A. And as you can see there, Part B covers doctor visits, ambulance services, medical equipment, mental health, preventative services, a lot of different things that we need to have covered as well. Medicare and what's available in the community, Medigap, Medicare supplements. Medicare supplement plans, are, we are licensed to help our clients with Medicare, but it's its own animal and it's its own world. And so what we usually do is we refer our clients out to a Medicare professional, a Medicare specialist in the Northern Virginia area to help our clients determine what plans are best for them when it comes to Part B and Part D, Medicare supplements. Health savings accounts. These are something that you really want to take advantage of if you can. We're on page 38 of your workbook and textbook, and you can only take advantage of a health savings account if you have a high deductible health insurance plan. I can tell you at our company, we do have a high deductible health insurance plan, and so we have HSAs available. If you could design a retirement account to look like what the HSA looks like, it would be the ideal, perfect retirement account. Too bad that doesn't exist, but it does exist for putting money away into a health savings account to be used for medical and health expenses. So here's how a health savings account works. You can put in this year, I believe 2020, about $7,000 if you're a married couple into these accounts, so $3,500 a piece. You can fully deduct 100% of that contribution into the HSA. So if you're married, a $7,000 deduction. Now, this is only if you have a high deductible health insurance plan. That's a deduction on top of your mortgage interest, a deduction on top of your 401ks and IRA contributions. Then once you take the deduction, all the money can come out of the plan and health savings account tax-free for any health expense. So I've had Invisalign the last year or so. My health savings account, I got a deduction on my contribution. I pulled money out to pay for my Invisalign, tax-free. Got the deduction up front, like you would with a 401k. But in a 401k, when you take money out, everything's taxable. There's nothing that exists in the retirement planning world where you can deduct money going into the account and have the money come out tax-free. It's either one or the other. A Roth IRA, you don't deduct anything going in and all the money comes out tax-free because you already paid taxes. It's one or the other. With a health savings account, you have both, but all the monies can only be used for a health expense. So it could be for your teeth, braces, Invisalign. It could be for chiropractic work, massage, acupuncture, any ancillary supplemental health type of expense, nutrition. So many different examples of where you can use this health savings accounts funds for. Long-term care. Let's talk about long-term care now. We're on page 39 of the workbook. 70% of retirees will need long-term care at some point in their life. What is long-term care? Long-term care is an insurance vehicle. It can be a specific insurance policy that you pay money for every month, $100, $200, $300, $400 a month. And if and when you do need the care, that policy will pay out a monthly benefit to the provider that you are using. So if you end up in a nursing home, if you end up needing care in your home, if you end up needing care in an adult daycare facility or assisted living facility, that policy will pay for the cost of care or some of the cost of care at the very least. Now, I can tell you that most financial advisors and professionals don't recommend standalone long-term care insurance anymore for a lot of reasons. One of the reasons is we can't predict if premiums are going to go up or not. And over the last 5 years or so, premiums have really gone up for a lot of long-term care policies. John Hancock and Genworth, some of the biggest long-term care providers, those rates have increased with them. Matter of fact, Genworth was the #1 long-term care insurance provider for a long time, and they have stopped providing long-term care insurance for any new person that wants to buy it. They've kept all their policies on the books for those people that have already bought policies, but they're not offering new long-term care insurance anymore. That should be pretty telling to you. What we instead recommend, which we're going to talk about in a few minutes here, are hybrid vehicles like life insurance policies that you can spend down while you're alive for this care. Annuities can have long-term care benefits in them, and sometimes just self-insuring and making sure you have money set aside for a long-term health care event can be the best thing for you. Activities of daily living. So how do they determine whether you're eligible for a long-term care benefit or not? Well, on page 40 of your workbook, it addresses the 6 activities of daily living. Those are bathing, showering, dressing, eating, toileting, and transferring. And if you can't do 2 of the 6 activities of daily living, you qualify for a long-term care benefit. So if you have a long-term care policy, they're going to say, okay, file the claim. If you believe that you need the care and are eligible, fill out the paperwork, fill out the claim paperwork, and prove to us that you're unable to do at least 2 of those 6 things. All you have to do for the most part with most policies is get it signed off on by a medical healthcare professional. Any healthcare professional typically can sign off on that. So those are the 6 activities of daily living. If you can't do 2 of the 6, you qualify for most long-term care insurance benefits. Now, if you have a pre-existing condition like cancer, like kidney failure, like a stroke, heart disease, it can make it pretty much impossible for you to qualify for this type of policy down the road because they're going to look at that pre-existing condition. They're going to say, well, we don't want to take you on. The chances of us having to pay out on this policy in the future are probably pretty high. So if you've already had an existing health condition like one of those I just mentioned, you might not be able to get this, unfortunately. Life insurance. Let's flip to page 42 of the workbook. One common question we get from class attendees and people that just come into our office for retirement income plans is, hey, Abe, I've had this life insurance policy for 30 years. My grandfather bought it for me. I've been paying $25 a month for it. All of a sudden, it's got $50,000 of cash in it. Should I use it for myself in my retirement? Should I cash it out? Should I keep it? Got this term life insurance policy for $500,000, but hey, my house is paid off. My kids are out of the home. Do I still need it? So we get these questions all the time. And let's go through a quick life insurance 101. So the 2 main types of life insurance out there are term and permanent. Okay, so term life insurance is designed to last for a term, just a period of time, not your whole life. So a term life insurance policy typically lasts for 10 years, 15 years, 20 years, or 30 years. Typically, it's one of those 4 time periods of time that you can purchase life insurance for. Now, I have term life insurance on my life, on my wife's life somewhat. And let's say I have a 30-year term. I'm 40 now. Let's say I purchase a 30-year term today. That would last me till age 70 at a guaranteed premium, and the death benefit would not change. But come 71, if I'm still alive, that life insurance is gone. There's no cash value. All the money's down the drain if I did not pass away. It's very costly. It's cheap. The premium's cheap every month while you're alive, but if you don't pass away, then all that money's down the drain. So it's like renting. The easiest way for me to explain the difference between term and permanent insurance, life insurance, is that term life insurance is like renting an apartment. Now, most of our class attendees and most of our clients in the Northern Virginia area and all over the country own their homes, and they understand the value of owning their own home. Okay, so they know owning a home can be more expensive sometimes, like with the maintenance, and you got to replace a roof every 15, 20 years. You got to replace your water. You got to replace your AC units and water filters, water heaters, and things like that every 5 to 10 years. That could be costly, where when you're renting, you don't have to deal with that. The landlord's going to deal with it. But what you are able to have with a home is appreciation, equity that you're building in the home, tax write-offs, deducting your mortgage interest, deducting your property taxes, and building equity to help you build a more successful retirement. So we really believe in real estate. We love it. And it's part of a really well-diversified retirement plan. And that's the difference between term and permanent. Permanent insurance, the 2 main types, are whole life and universal life. Permanent insurance is designed to last you the rest of your life. Well, the rest of my life, if I lived to 100, that's 60 more years. 60 more years of life insurance is going to cost more than 30 more years or 10 more years or 20 more years naturally, right? So with whole life and universal life, insurance companies charge a premium upfront that's guaranteed for life and is designed to last you the rest of your life. So, a term life insurance policy for me right now, if I were to buy $1 million of term for 30 years for a male that's 40 years old, might cost me $100 a month. If I were to buy $1 million of permanent life insurance as a 40-year-old male, that might cost me $500 a month. Okay, there's a $400 monthly difference there. However, if I live to 71, the term's gone, all my money's down the drain. If I live past 71, my permanent life insurance is still intact, and I've got all this cash that I've built inside the policy, all this equity that's inside my home. And that there is a difference between term and permanent insurance. Just think of it as a difference between renting and owning a home. When it comes to permanent life insurance, like owning your home, you've got two main types there you can see on the screen: whole life and universal life. Long story short, whole life insurance is not flexible. It's designed to charge you a premium that lasts to age 100. You may say, well, that's silly. I'm going to live a long time, but I might not live to age 100. I might live to when I'm 80, 85, 90, 95. And why would I pay a premium that's designed to last me to age 100 if I'm not going to live that long anyways? I'm going to live past 70, but maybe I'll live to 90. So in the early 1980s, the same insurance companies that offered term and whole life came out with universal life. Universal life is technically called flexible premium adjustable life. Flexible premium adjustable life. This means as you continue to pay into the policy, you can increase the premiums up and down. You can increase the death benefit up and down to match your lifestyle. As the kids leave the home, as you have debts paid down, you can decrease your death benefit. As you have pay raises and your income goes up, you can put more money into the policy to help you save more for retirement and to build up that cash nest egg inside the policy. And those are the differences between term and permanent, and the differences between whole life and universal life. Bottom line is, we like universal life a lot. We like it better than whole life because it is flexible, and we want flexibility as we plan for our retirement. Let's see here. This is an example of actually a hybrid policy. I kind of alluded to this just a few minutes ago, and I mentioned that we don't like standalone long-term care insurance because it's so inflexible. So with standalone long-term care insurance, you can pay several $100s a month for 20, 30 years and pass away and never need the care. Well, all that money's down the drain if that happens, okay? Now, if you're like one of my grandmothers who started needing care at 90 and didn't pass away to 95, that's 5 years of care she needed. She started on the top floor where she always lived and moved down to the middle floor. On that middle floor, they brought in a hospital bed, right? So she can get in and out of the bed easier. They brought her to the hospital bed, and my family would have one nurse come in every few hours, okay, to check up on her, just temporary care and a temporary nurse. Well, eventually they needed two nurses, right? Because she needed full-time care. So she goes from upstairs to the middle floor, her own bed to a hospital style bed, a part-time nurse to a full-time nurse, and one full-time nurse to two full-time nurses, nurses that could watch her 24/7. From there on out, about a year or two away until she passed away, she was in and out of the hospital, and she passed away at 95. But my point there is, she needed care for 5 years. And if that happens to you, then you need to have something in your plan to help you with health care and long-term care. We really like hybrid vehicles that can cover long-term care, that can cover life insurance, and that can help you build savings. So this is an example of a couple that bought life insurance with built-in long-term care. So let's say you're paying $300 a month or $200 a month for a permanent life insurance policy that has a death benefit of $300,000. If you had a hybrid policy that offers long-term care inside the death benefit, which we do have and do make available to our clients, then that death benefit that would otherwise have to pass on to your loved ones when you die can be spent down entirely while you're alive. Okay, so with life insurance, the great thing about that is we know we're going to pass away at some point. It's not if, it's when. All right, so we're paying money and premium into a policy that's guaranteed to pay out one way or the other. If you need the cash inside the plan, you can access cash. If you don't need the care, you're going to pass all the death benefit on tax-free to your loved ones. And if you do need this care that's so important to be covered for, you can spend down that whole tax-free death benefit every single month for the care. So if you had a $300,000 life insurance policy, these insurance companies will allow you to accelerate 2% of the death benefit every single month for the care. You have a $300,000 death benefit or life insurance policy, that would equal $6,000 a month of long-term care. Would you rather pay premium into a policy that you can use 3 ways or 1 way? And so big-time financial advisors, ourselves included, we recommend using these hybrid vehicles that are much more flexible, that can be used 3 different ways instead of 1. Section 4, estate planning. This would be page 46, 47 in your textbook and workbook. Estate planning is something that only 1 in 3 Americans have done. Estate planning basically helps you and your loved ones to determine, let's say you're married, helps you and your spouse to determine who you want all of your hard-earned dollars and assets to go to when you pass away. So only 1 in 3 Americans has an estate plan done, has a will and a trust set up. Yet this is one of the most important parts of the retirement planning process. Think about this. You're going to work for 20, 30, 40, 50 years, and you're going to work your butt off, and you're going to travel a lot over this DC metro area to get to your job and come back, a lot of commute times. You're going to work hard just to make sure you have enough money saved for your family in retirement. God forbid you pass away with one of these estate plans not set up. You're going to make it very difficult for your spouse. You're going to make it very difficult for your children and grandchildren and loved ones that you pass these assets on to. Here's why. If you just have a will and you don't have a living trust set up, then everything you own goes through probate. What probate is a court process, a state-sanctioned court process where the state determines, okay, Abe and Shelley, you have a house, you have this amount of money, you have these accounts. Let's say I pass away and I pass everything on to my wife and I don't have an estate plan set up. They're going to say, okay, well, you've got a wife. She's first in line to all of your assets. If she's passed away, you got kids. They're next in line to all your assets. You got grandkids. They're next in line as well. But that takes time. And do you really want the state and the courts determining who gets your money? Right? So it takes time to sort all that stuff out. And money. You got to hire an attorney to help you sort all that stuff out so that your family gets all of your hard-earned assets. With a living trust, you can really specify and dictate who you want all your assets to go to. Who, when, where, how, why. You can say, you know what? I don't want any of my assets to go to this child because they just can't handle the money. And they're off on their own and they're doing drugs and they can't handle the money anyways. You know what? I want more money to go to this child because they're disabled and they're going to need more money to help with their disability. You know what? I want all this money to go to my church or my school, whatever it is that you want to have set up. You can be really specific in a good, solid estate plan with a revocable living trust and wills that really help your spouse and help your family to determine where all these assets go. In other words, get all this set up before you pass away so that when you do pass away, and a lot of times it's unexpectedly, things pass on to your loved ones exactly the way you would want them to pass on. Very important part of retirement planning. See where we're at in the workbook. We're on page 47 and 48. A lot of questions. We have estate planning worksheets, and you got them in your book there that you can kind of go through on your own and get a good assessment of whether you've set these things up or not. And I'll tell you what, with trusts, a lot of times we have clients come in and they have set up a trust, 5, 10 years ago, and the trust is not funded. I can tell you it's worthless. If the trust isn't funded and your house and your real estate properties are not in the trust, if your bank accounts and brokerage investment accounts are not in the trust is worthless. You just paid $3,000, $5,000 for a 200-page binder that's literally worthless. So if you have a trust, it needs to be titled and funded properly to make it worthwhile, okay? Because if those assets are not in the trust, then it's worthless. And a lot of times, believe it or not, we'll have clients come in, they'll have paid thousands of dollars to some attorney in the area to give them a cookie cutter binder full of papers, and the trust is worthless because it's not funded. Make sure it's funded properly. Estate planning terms, these are some of the basics. I'm not going to go over every single term there, but this is on page 49 of your textbook and workbook. A will, it's a legal document that declares and controls how a person's property and assets are passed on. Probate, kind of talked about that. A legal process that reviews a will to determine if it's valid. And so essentially, the courts and state is determining where all of your assets go. You don't want that, right? In addition, without a trust, everything is public record. So when you pass away without a trust, anybody can search for your name and say, oh, your house is worth $600,000. Oh, you got $1 million in your 401k. Yeah, that's public record. It's not if all those assets are in a trust. Power of attorney, living trust, I kind of just talked about that. Beneficiary, that's obvious. That's somebody who is the recipient of your assets. Choosing beneficiaries. Now, we know the basics of estate planning, and anything we don't know, we refer out to estate planning firms that are really well known and do a really good job for our clients here in the Northern Virginia and DC metro area. We partner with an estate planning firm that hosts educational workshops and classes just like this one this evening. And so I'd recommend going to a class where you can learn more about the basics of estate planning. But these are a lot of questions to consider when you're setting up your will and trust. Who do you want the money to go to? Do you own a business? Who's going to be the successor of your business if you want it to continue? I know I want our business to continue after I'm not here. When I'm retired, you know, when we have children, if they want to be in the retirement planning world and helping people retire successfully, then man, I would love for our business to continue. So that's important to me. And are your beneficiaries capable of handling your property when you pass it on? Or do you have a disabled child? You know, if you have a disabled child, they may not have the intellect and the ability to really handle these assets. So you need someone there for them to be able to handle the assets for them. Beneficiary analysis, primary, contingent. Basically here, primary beneficiary is typically going to be your spouse if you're married. If you're single, it could be one of your children or your children. It could be a sibling, a parent. Contingent beneficiary. If you're married, your spouse is usually going to be your primary beneficiary. A contingent beneficiary could be the trust you have set up. It could be your children or child. A secondary beneficiary should your spouse or primary beneficiary pass away first. Section 5, income planning. Page 54 in the textbook and workbook. And now we're on page 55. Here are a bunch of different income needs and income risks. Common income sources, defined benefit plans. That's going to be 401k. A pension plan, which are few and far between these days. You know, the government offers a pension plan. A lot of teachers have pensions, but man, I can't tell you how many times clients come into our retail office and say, hey, Abe, you know, I work with Verizon and they just offered me this lump sum buyout package for my pension. Can you help us decide what to do with the money? This is happening more and more with companies all across the country because they see that there's too much risk to keep this pension plan at the company, and that should be telling for you. If they're offering you a buyout package and they're offering you $500,000, $50,000, $300,000 to take that money today and do something with it on your own, that should be pretty telling. All right. And a lot of times it makes sense for you to take that money in a lump sum and reinvest it safely on your own. Other common income sources in retirement: IRAs, Social Security, annuities, dividend income and interest from your stocks, and rental income from your real estate portfolio. Income needs and income risks. Common income risks: longevity risk. That's outliving your income. That's living too long. And that's outliving your money. In other words, your money's run out. You're still alive and the income isn't coming in anymore. That's a real serious risk, especially if early in retirement you suffer losses in retirement, the stock market's down, early in retirement, that can really crush your investment values and make it so that in your 80s and 90s, you run out of money. Inflation risk. Well, this is a serious risk as well. And all of the income plans we put together for our class attendees and clients factor in a 2.5% inflation increase, meaning that if you need $100,000 a year today to live on, in 10 years, you might need 150. In 20 years, that's going to be $200,000 that you need coming in when today you needed 100. Inflation is a real deal, is the real deal. And you can, imagine what gas and milk cost 20 years ago. You were probably able to fill up your gas tank for $1.50, probably even buy a gallon of milk for the same price. Now a gallon of milk costs what, $3 or $4, and you're paying $2.50 to $3 at this point to fill up your gas tank. So inflation is real, and it's something we need to have factored into your income plan. Tax risk, if taxes rise, we've talked about that. Healthcare risk, we've talked about that. Relationship risk, divorces and different things. That can be planned for with a good estate plan, wills and trusts. Sudden change risks. Do you think that COVID-19 is a sudden change risk? Absolutely. Nothing that we were able to control, but man, this is a black swan. This is an unforeseen pandemic, global pandemic that nobody in the world saw coming, and that is affecting every single country in the world, every single person's retirement account and job and all those different kind of things. So a lot of that we can't control, but we can control how we invest, where we put our monies, how we pay taxes, where we choose to invest in. And so we can control losing 30% of our portfolio in 3.5 weeks. We can. You don't have to be 100% in stocks. A lot of it we can control and some we can't. Employment and sources of income. This is basically just a budgeting spreadsheet and asset spreadsheet we can give you to help come up with a budget and to help come up with help you to come up with an income spreadsheet that shows all of your income streams. We put that then together and into an income plan for you, a roadmap that you can follow for your retirement. And there's the budgeting spreadsheet there. Simple monthly expense form, but believe it or not, a lot of people haven't even put together a budget, which is why a lot of Americans have very little saved for retirement. That's not the case with the baby boomers we meet with and work with all across this area. Most of our clients have done a good job of saving. And if you're watching this webinar tonight, you probably have as well. Otherwise, you wouldn't be on a 2-hour retirement planning webinar. You're being proactive. So kudos to you for taking the time to learn more. Putting it all together, we'll put it together into a retirement income plan, a roadmap so you can see exactly how much money is coming in every month and every year adjusted for inflation. And if you have enough income to come in for the next 30 to 40 years. Sequence risk, sequence of returns risk. This is going to be page 59 of your workbook, 59 and 60. This is a real serious risk that a lot of financial professionals don't talk about, that retirees are facing right now. 2019, the S&P 500 and major indexes were up 30%. 2025, 35%. And in just 3.5 weeks, from late February to late March of 2020, we have lost it all. In other words, these major indexes are down the same amount in 3.5 weeks that it took to earn that amount of growth in 1 year. The fastest decline in stock market history, I believe. The fastest decline to a recession and bear market in stock market history. So a lot of people think that they can time the market, and a lot of people think that they can, get out when the market's super high, get out before the market dips. But man, this took a lot of people off guard. So what sequence risk is the risk to you as a retiree that when you're retired and your working income has stopped, your paychecks have stopped, that as you're drawing down on your portfolio for income and retirement to live off of, the stock market is also down at the same time. Double whammy, double negative, potentially triple whammy or triple negative if you're paying an advisor a fee or if you have fees inside your funds, which you do, right? So let's say you're drawing down 4% of your $1 million you've saved, $40,000 a year for supplemental income to sit on top of your Social Security and pension. You're drawing down 4% using the 4% rule. And that year, let's say the market's down 10. Well, you know what? You're down 14. Plus the fee that you're paying to the financial professional or the fee inside your funds, double or triple whammy. And guess what? Next year, you got to go back into the piggy bank for another 4% if you're in the RMD phase, required minimum distribution phase. And next year, if you're retired, you're not working anymore, you got to go back into the account for another 4% because you need the income to live off of. If the market's down again, and we have a tech bubble type of scenario where the market's down 3 years in a row, man, that can really make it a bad situation because you have a double or triple negative. If that happens early in retirement and your portfolio is down while you're pulling money out at the same time, it can crush your investments. So one simple way we help our class attendees and clients plan is to separate and segregate your retirement funds to serve two different purposes. Some for growth, some for income. It's as simple as that. If you need $500,000 of your million to create supplemental income in retirement, then we cannot fool around with that $500,000. That has to be very safe. It has to have downside protection. It cannot lose 20 or 30% like your stocks just did in the last 3.5 weeks. The other $500,000, if you don't need that for income right now or in the near future, can be set aside for long-term growth. It's okay if we lose money on that portion of funds because we have 5 years, 10 years, 30 years to grow that money without needing it for income right away. I hope that makes sense to people. Here's a great classic example of sequence risk and how it will affect your portfolio. So if we started with $250,000 of investments, and let's say you retired between the years of 2000 to 2018. So you retired in the year 2000 with $250,000 total, or let's say $250,000 that you are going to be using for income in retirement. Then here's how your portfolio would have done in that 18 years. You started with $250,000. We had 3 down years in a row, the tech bubble. We have 2008. 2 years ago, we had a negative 6% return in the S&P 500, even though last year in 2019 it was up 30. And if you're taking out 4% per year for income following the 4% rule, then you can see in that first 3 years there, we have triple whammy. We have the loss in the market, your withdrawal, and the fee you're paying to your advisor or the fee in the funds that you're invested in. And look at the ending balance in 18 years. You have less than $10,000 left. You started with $250,000. You're only taking out 4%. You got hit hard with 3 losses in a row in the beginning. You have less than $10,000 left. You might only be 78 years old. You might only be 83 years old, and you have nothing left because you took big losses up front in retirement. Now, what if you could have strategies built into your portfolio where you avoid losses in retirement and you replace this red over here and these losses with zeros with total downside protection? And then what if we just get 50% of the market upside? So when the S&P is up 26, we're up 13. When the S&P is up 9, we're up 4.5. When it's up 3, we're up 1.5. And instead of suffering any losses, we get a 0. Where 0 is the hero, and we have true downside protection. Look at the difference at the end of 18 years. Over here, even though our total growth might have been less, we have $203,000 left at the end of 18 years. Where over here in the market, we have $10,000 left. Now, every 18 years is different, and sometimes it's going to be better or worse on each side, but that goes to show you, and we firmly believe as a firm and as a retirement educator, that avoiding losses in retirement is more important to a retiree than gaining a 20 or 30% return in 1 year. And we just found that out in the last month. Yeah, a lot of people got 30% in the S&P last year and in your stocks, but look how quickly you lost it in 3 weeks. And sure, the market's going to rebound and go back up. And that's okay if you're young, and that's okay for money you don't need for income. But if this is money you need for income in retirement, that is not a good thing. That is a problem, as you can see with a $10,000 balance left at the end of 18 years. So hopefully that was a good explanation of sequence risk and how we can help you to avoid it simply by separating and segregating your monies to serve a different purpose, On that left-hand side, maybe we say, you know what, we'll invest, more aggressively in the market with this stock money because we don't need it for 5, 10, 30 years. The money on the right, we need for income right now. We need for income in 2 years, 5 years. We can't afford to be aggressive with it. Defined contribution and defined benefit plans. So this would be page 61. And basically the common difference, the simple difference between the two is that a defined benefit plan is a pension. Now, most people don't have pensions anymore, but for those that do, you might have a pension through the federal government, the state, county government. If you're a teacher, you work for a private company for 20 or 30 years, they may have a pension. Most people don't anymore, but you might. A defined contribution plan is a plan that you contribute to for your retirement. So a 401k, 403b, a TSP, if you're a government employee or former government employee and listening to this webinar. A defined contribution plan is a plan that you contribute to and a plan that your employer contributes to often as well via a matching provision. That's the difference there between a defined benefit plan and a defined contribution plan. RMDs. Let's talk about RMDs, required minimum distributions. That's on page 65 and 66 of your workbook and textbook if you're still following along. Now, these rules just changed in December of 2019. And basically, if you weren't 70 and a half already in 2019, then your first RMD is not due until age 72. If you were already 70 and a half in 2019 and already taking out required minimum distributions, then those rules still apply to you. You're grandfathered into the old rules and you have to continue to take RMDs out. You can't defer them any longer. In addition, when these rules changed in the Secure Act, and Congress passed the Secure Act in December of 2019, bumping RMD ages to 72, what also changed with these RMD rules is passing money on to a non-spousal beneficiary. So let's say my wife passes away and we have children and grandchildren, and I pass on all that money to my children and grandchildren in a 401k or IRA. I pass that money on, my wife's gone, non-spousal beneficiary receives this money, children, grandchildren, nieces, nephews, parents, anybody but a spouse. Since after these rules just changed in December of 2019, those non-spousal beneficiaries will only have 10 years to deplete all that money in that account, 10 years. In the past rulings, and basically in December of 2019 and prior, if you passed money on to a non-spousal beneficiary, they could stretch out those RMDs over their lifetime. So think about that. Let's say I pass money on to my kids when they're 60. I'm 90, I pass away. I pass my money on to my kids when they're 60. They may be at their peak earning careers. They may be at the end of their earning careers, the end of their career where they're earning more money than they ever have before. I pass on $1 million to them, and all of a sudden, over the next 5 or 10 years, they got to deplete and withdraw every penny out of that 401k or IRA. Think about what that's going to do to your children and grandchildren's tax situations at that point. It's going to create a lot of tax mess. So anytime the government gives us something, they're going to take something away. That's a long and short of RMDs. Your first RMD can be taken by April 1st following the year you turn 70 and a half or 72. And then every year after that, your RMDs have to be taken out by 12/31 of each year. Other than Roth IRAs, RMDs are due on every single qualified pre-taxed account you have: 401ks, TSPs, 403bs, SEP IRAs, traditional IRAs. Roth IRAs are the only retirement account, the only IRA or retirement type of account which don't require required minimum distributions. As you can see here on page 66 in your workbook and on the PowerPoint right here, these are different factor numbers. There are different factor numbers here for every age that you are. So you can see there the factor number for a 72-year-old is 25.6. Here's how you figure out the RMD. You will simply take that factor number of 25.6 at 72, and you will take that and divide that into the total amount of pre-tax monies that you have. So if you've got $1 million in your 401k or $1 million total in pre-tax dollars, You take $1 million divided by 25.6, and you'll find out that your RMD is going to be about $39,000, about 3.9%. So your first RMDs start out at just under 4%, but every year as you age, the factor numbers go down here, but the percentage goes up. Think about that. You've deferred money in your 401ks and pre-tax plans for 20, 30, 40, 50 years without paying a penny of tax. Now you're sitting over here at 70, 72. You may only live to 85, 90, and Uncle Sam's saying, man, I need to get out as much money of this account as possible. We need as much tax revenue as possible. So as you age and get older, the percentage you have to take out for RMDs goes up. At 75 years of age, the percentage you have to take out is 4.4. 4.4. At age 80, the amount you have to take out is 5.35%. Age 90, the amount's over 8%, approaching 9. So basically, at 70.5 to 72, we need to be earning 4% or more on all of your qualified dollars to keep up with required minimum distributions. And you may say, well, Abe, I'm just not going to take out my RMD if the market's down. Well, guess what happens if you don't take out your RMD and you say you forget or choose not to? 50% penalty. 50% penalty on any amount that you are supposed to take out. So if you have $1 million, your RMD is roughly $40,000. That's a $20,000 penalty. Let me tell you, that is the second biggest penalty in the IRS tax code, short and second to anti-money laundering and fraud. Can you believe that? The second biggest penalty in the IRS tax code, second to anti-money laundering and fraud. A retiree's on vacation. They're on a cruise ship, December, January, getting away from DC because it's cold. They're in the Caribbean and they just forget. 50% penalty. So that's one of many reasons why it's so important to work with a financial professional, an educator that can guide you through all these different things and make sure you're doing things the right way and on top of all these moving parts. How are RMDs taxed? Well, this should be on page 67 of your textbook. RMDs are taxed at ordinary income. Think about this. If you have deducted all the contributions into your 401k plan for 40 or 50 years and you haven't paid a penny of tax yet, it's time to pay the piper. And you're going to be paying taxes at ordinary income and whatever ordinary income bracket you're in at that point. Now, as we talked about before, a lot of people think they're going to be in a lower tax bracket when they retire, and that's one of the biggest myths of retirement. You got your house paid off. The kids are out of the home. You're not maxing out your accounts. You've got pension, Social Security, annuities, dividend income, rental income, and then you've got a $20,000, $50,000, $100,000 RMD coming in, mandatory, that's sitting on top of all that extra income. Imagine what that could do to your tax brackets. So RMD planning is extremely important and one way of many that we help people that are 70 and a half and older. And there's that penalty right there. Failure to take out an RMD, 50% penalty, not tax. Taxes are on top of that. So if you had to take out $40,000 for your RMD and you forget or just mess it up, you lost $20,000 right off the top. Then you got to pay taxes. So after you pay another 20 to 30% in tax, you're down to probably like 10 to 15 grand on a $40,000 RMD. Now, we have a lot of clients that like to continue to tithe and donate and give charitably to the nonprofits of their choices in retirement. One great way for you to be able to continue to do that is through qualified charitable deductions, and this is only for RMDs. So when you're in retirement, we're not talking about cash contributions to the charity of your choice. We're talking about RMD contributions or RMD deductions. This can be through a qualified charitable distribution. So let's say you're in the RMD phase, you're required to take out RMDs, you're 72 and older, your RMD is $40,000. You may say, Abe, I don't want it, I don't need it, I don't want to touch it. You can send that whole $40,000 to your church, Habitat for Humanity, your college, whoever, the charity of your choice. You don't pay a penny of tax on it, and the institution or the nonprofit 501c3 does not pay a penny on that charitable deduction or contribution either. That's a beautiful thing. And one way you can continue to give charitably in retirement. Contribution limits on 401ks and IRAs. So we are on page 69. Okay. So for 2020, I believe this has now gone up to $19,500. So anyone 50 or younger, $19,500, and then anyone 50 or older, there is a $6,000 catch-up contribution, where if you're 50 or older, you can put away $25,500 into the plan, $25,500 into the plan if you're 50 or older. And then here are some other retirement plans and the contribution limits that we can put in or put into those plans, 50 and younger and 50 and older. Rule of 100. This is the common financial planning and retirement planning rule of thumb that we use to help our class attendees and clients to give them a good idea as to how much risk they should be taking in their portfolio. If you are following the rule to a T, what you do is you take 100 minus your age, and that equals the risk that you should be taking in your portfolio. In other words, let's say you're 60 and you're retiring in 5 years at 65. You got $1 million saved in your 401ks or IRAs. Okay, you take 100 minus 60, that's your age, that equals 40. 40 is the percentage that you should be invested in stocks or in the stock market. 60% should be safe. Why? Because you're retiring in 5 years. And the last thing you want to have happen is a 30% loss leading up to full retirement, because you need that $1 million to generate the income that you want to need in retirement. So where does that 60% go? That 60% goes into something super safe, right? CDs, treasuries, money markets, perhaps some bonds, fixed and fixed index annuities that can protect your principal when the market goes down anything and can guarantee income and give you a decent return. That's what we call safe. Okay, so that's the rule of 100 and a good rule of thumb to use when determining how much risk should you take. And one thing, probably the most important question we'll ask to our class attendees as they come in for the labs here in our office, and as they have the labs via phone and computer here virtually in this time, is what is your risk tolerance? And does your risk tolerance match up to the way you're investing? In other words, I'll ask people, hey, where are you on the risk tolerance scale? With 1 being super conservative, where you don't want to lose a penny, and 10 being super aggressive, where you're 100% in stocks. Where are you on that 1 to 10 scale? The other day, right after this downturn, a gentleman told me -4. -4, and I laughed. Wasn't laughing at him, was laughing with him, because that basically told me he does not want to lose a penny. They're in retirement and they want to sleep at night. They don't want to be dealing with this stuff that's going on in the market right now. Now, most people we meet with, most class attendees that will come in for the lab will tell us, I'm a 5, a 6. If you're above a 6 on that scale, you're a more aggressive investor. If you're a 3 or a 4, a 2, you are a conservative investor. If you're 1 to 2, very conservative. If you're 8 to 10, you're very risky and aggressive. Where most baby boomers fall on that scale is usually somewhere in between a 4 to a 6, because they know they need to take some risk with some of their portfolio because they might live another 30 years. They also know they need to reduce risk and de-risk their investments right at the point of retirement. And that would call for maybe a 50-50 split, 60-40, 40-60, in those ranges. Let's talk about annuities. This is on page 71 and 72. Now, we've got 4 different types of annuities here, and this is going to be a really brief annuity 101. You've got immediate, fixed, fixed indexed, and variable. Okay. Long story short, anytime you hear anything good about annuities, and there's a lot out there about annuities, anytime you hear anything good about annuities, it typically comes from number 2 and number 3, fixed and fixed indexed. Anytime you hear something bad about annuities, it typically comes from number 1 and number 4. Variable annuities can go up and down because they're in the market. Okay, so right now with the markets being down 20 to 30%, variable annuities are going to be down that same amount. In addition, the fees are very high. 2, 3, 4% in annual fees on top of the losses. Imagine how that could impact you in retirement. Not a good deal. And most financial professionals do not recommend them. Let's go back to number 1, immediate annuities. We don't recommend immediate annuities with your own money, because if you put your own money into number 1, an immediate annuity, it will pay you income immediately, but you lose total control to all that money in that immediate annuity. We don't want to lose control of our investments. We want to retain control. We want flexibility and control of our investments as we invest over our life. So we've never had a client come into our office where they said, Abe, I need income right now. I need income next month. I can't defer or delay any of my monies. I need income next month. We've never had that happen. So we've never put a penny of our clients' monies into number 1. Number 2, we call this or nickname this a CD on steroids. So right now, in the current interest rate environment, it's very hard to get a decent return on a CD. In a 5-year CD right now, you'd be lucky if you can get 2%. In a fixed annuity, which is like a CD on steroids, you can get 3% right now guaranteed. 3, 3, 3, 3, 3 every single year for 5 years, tax deferred, compounded, and then at the end of 5 years, you can determine what you want to do with the monies. Fixed indexed. Number 3, we will use fixed index annuities for several reasons for our clients. When someone wants downside protection in the plan, we can use a fixed index annuity. When someone wants downside protection with upside potential, not all the returns of the market, but some of them, fixed index annuities are a great strategy for anybody who needs additional income in retirement, for anybody who wants to de-risk the portfolio at the point of retirement or into retirement. It can act as a great bond alternative. Okay, a lot of financial advisors recommend stocks and bonds. Bonds are not going to pay what they used to in the past, in the future. So a fixed index annuity can be a great bond alternative that's going to be less risky than a bond and give you higher upside potential. The combination actually of a fixed index annuity with stocks has been proven by several Nobel Prize winning economists to create the most optimal portfolio a retiree can create. And these are some of several strategies that we can help our class attendees and clients with. Annuities have a lot of moving parts. Look, they're not perfect. Neither is any investment you own. You need to understand the details. You need to understand the moving parts. Does it have a fee? Does it not have a fee? How long is the annuity? What's the surrender charge period? What are the limitations? There are limitations. There are restrictions. No investment's perfect. And you need to understand, first off, is this something that's suitable for you? Is this something that's going to meet your needs? And if so, why? Why are we putting this into your portfolio? So you need to be on the same page with the expectations. What are you expecting this to do for you? And make sure you're on the same page with those expectations. Different terms there when it comes to annuities, riders, surrender charges. We walk our clients through all those different types of things. Additional interest or income. This is on page 75 and 76 of your textbook. Dividends and interest. Obviously, this would come from stocks. Perhaps rental income, which we'll talk about in a minute. Interest on bonds, interest on a CD, and dividend income from stocks. So we believe in having a really well-diversified portfolio. A really well-diversified portfolio is going to have investments and income streams coming from several different income sources: real estate, annuities, pensions, Social Security, dividends on stocks, bonds, all these types of different things. You don't want all of your income coming from one source. You don't want all of your income coming from real estate, because although we love real estate, there's pros and cons with real estate too. So you have some rental income, fantastic. But let's not have all of our eggs in one basket. We don't want all of our money in annuities. We don't want all of our money in stocks. There's rental income. And in the DC metro area, man, rental properties can be a fantastic tool that you've added to your portfolio for diversification. We're not going to take a break. We're headed here towards the very end of our class tonight. And let's talk about section 6, page 79 of your workbook and textbook, financial tools and products. Risk reward, that's something that we have to weigh as we invest. Well, let's talk about stocks. Stocks have unlimited upside. And man, This 11-year bull run we've had up until March of 2020 has been a fantastic bull run. The longest bull run in stock market history, 11 years without a bear market. And we finally just hit a bear market and recession in March of 2020. 11 years where that didn't happen. The longest bull run in history. Typically, what happens is every 4 or 5 years, the market goes up, then has a correction. 4 or 5 years, correction. This bull run was more than 2 times the average bull run in the market. So yes, with stocks, we have an unlimited upside and we have an unlimited downside. Hey, this year in 2020, it could be a worse year than 2008. We'll see what happens. But in 2008, from peak to trough, from the top of 2008 to the bottom of 2009, when the market bottomed out, the S&P 500 lost 57%. 57. That would be crushing. That would be devastating if that happened right before you retired or right into retirement. We cannot have that happen. But we need to have money in stocks, and depending on your risk tolerance, that might be 20 or 30%, it might be 40, 50, 60. Just know that if you have more than 60% of your money in stocks and you're in your 60s or older, that's an aggressive stance and position. And just know that if you're earning 20 or 30 and you're loving that 20 to 30% return, you better be prepared to lose 20 or 30 because it will happen. There's pros and cons of stocks. And let's talk about mutual funds. Mutual funds are basically a combination of a bunch of different companies. You can have one fund that has 50 companies, 100 companies in it. So, it's less risky than investing in one company's stock. As we're finding out right now, hey, some of these airline stocks and hotel industry stocks and cruise line stocks are not doing well because they're closed. They're essentially closed or severely limited in their operations, and their stock price and prices are getting hammered. Their dividends are being stopped. And so by investing in a mutual fund or index fund, it's going to reduce risk somewhat, and you can pull that risk and invest in a collection of different companies. More than 7,000 mutual funds out there to invest in. And we got pros and cons with mutual funds. Let's talk about CDs next and bank cash. Bank CDs. Well, I'll tell you what, with the Federal Reserve pulling out every tool in their toolkit in the spring of 2020 to keep the economy from tanking, they've lowered interest rates to all-time historic lows, which is going to make it very hard to earn anything really on your super safe money, your treasuries, your CDs, your money market funds, your checking and savings accounts probably are earning less than 0.5%. You'd be lucky to get 2% in the bank right now, which isn't keeping up with inflation. So yes, you need money set aside for emergencies. The roof's going to go, the water heater's going to go, you're going to need a new car. But if you've got 2 years or more of cash reserves on hand, 200 grand, 500 grand, which believe it or not, we see, you are losing money. You're paying a price for being too safe. And those funds are not keeping up with inflation, nor do they have any tax advantage. Real estate, kind of talked about the pros and cons of that. Real estate, you can depreciate the asset as you own it longer and longer. You can rent it out, create great rental income. But you got pros and cons too there. I don't have to list every one. You can see it there on the screen for you. Tax benefits, tax write-offs. The rental income is a positive. Yeah, but sometimes the rental property can go unrented. And think about right now with people not traveling. Let's say you have an Airbnb property at the beach. Well, airlines are closed. You can't fly there. Everything's locked down. You're probably not going to be able to rent out that rental property if nobody's traveling and everybody's isolated at home. Annuities, we talked about those already. Those have pros and cons as well. And I believe we are here at the end of our class. I'm going to be wrapping up here just in the next minute or two, I believe. Pros and cons of every investment you make. You just need to know what they are. Market risk, would you rather have a 5.58% average return or a 5.17% average return? Well, basically this is talking about sequence risk. We kind of talked about that already. And we already talked about that already with sequence risk and how sequence risk can affect your portfolio values as you draw down on them. So we're going to skip right over that. Average returns versus actual returns. This is something that a lot of people aren't aware of. If we gave you $2 and you earned a 50% rate of return in your first year, you're up to $3, right? $2 plus 1 is 3. If you lose 50% in the second year, because you're up 50 the first year, you're down to $1.50. But the average return is 0. So you're up 50, down 50. Sounds like you're okay, but you actually have a negative 25% return. Let's do it the other way around. Let's say we start you off with $2. You lose 50% in the first year. You're down to $1. You earn 50% the second year. It sounds like you're okay, down 50, up 50. But you're down to $1, you earn 50% the next year, you're only back up to $1.50. You started with $2, negative 25% return in that 2-year period of time, even though you average 0. You might think being down 50% is unheard of, but the S&P 500 in 2008 to 2009 was down 57%. You might think a 50% return is unheard of. Well, last year in 2019, the NASDAQ was up 38, so we're approaching 40. And those returns can happen on stocks from time to time. Standard deviation, drawdown. We've talked about peak to trough in the S&P, actual versus average returns. These are things you need to know how they work. All right, next steps. We are finished with this class, with this virtual class. And what I'd like to remind you of is that hopefully you were submitting questions throughout the webinar in the digital chat. Our team members, I'm sure, answered those questions. But if there are any questions you have that are unanswered, just let us know. We can get those questions answered for you. This is the point of time in the class where I'd like to remind you of the story I told you. At the beginning of the webinar, I talked about the Great Blondin. And the Great Blondin was the guy that walked across the tightrope across Niagara Falls many, many times without falling. And one of the last times he did it, a guy jumped in the wheelbarrow with him and made it across Niagara Falls successfully. The guy jumped in a wheelbarrow with a guy, walked across the tightrope across Niagara Falls, 150 feet high, and made it across successfully. So there are two types of people, again, that would have listened to this webinar. First type of person would have just soaked up all the information and is not going to take any action on it when it comes to their retirement. And so really, the information is going to be pretty useless if you don't take any action. And the second group of people that have listened to this webinar are going to take action, and they're going to have jumped in the wheelbarrow with us across Niagara Falls safely so we can help you get in the wheelbarrow, cross Niagara Falls successfully, cross the finish line into retirement successfully, put all this information into action. And it's only then that you'll truly succeed financially, when you're walking hand in hand with a financial professional that can guide you through all these different areas. It's so hard for us as financial professionals to keep up with these ever-changing tax laws and rules and regulations. So working with a financial professional can help you in so many ways. It's the second part of this class is a lab session. So we encourage you to click on the direct link there in the digital chat. Our team members have included a live link there. You can just click on that link and schedule, linked right to our calendar. Okay, if you are not in the digital chat room right now and don't have access to that live link right now in the webinar, then just go right to our website, and there is a red bar at the top of our website. If you click on that, and on several pages of our website, it'll take you to an area where you can request an appointment. We'd love to host this lab session with you that's going to put all this information into an actionable plan and test out all this information on yourself. So that's the second part of the course. We'd highly recommend that you do that and would love to provide all this information to you. Again, I'm Abe Abich, the local retirement educator for American Retirement Institute, presenting the Retirement Today course for you this evening. It's been a pleasure hosting this webinar with you tonight, and we look forward to seeing you in the future. Thank you very much.